This is Danielle, and today we're going to be talking about iron condors, also called iron butterflies. I like to call them iron condors primarily because that's what they are called in Thinkorswim, at least with the way that I set them up. And I use Thinkorswim, and so I think that it's can cause a little bit of a confusion if you call it a different name rather than what is in the platform. But technically, it is called an iron butterfly. So what we're going to be talking about today is this type of options trade setup, why we use it, when we use it, and how we use it. So, I'm going to first start off by talking about Tesla because I think that this is a pretty reasonable ticker to give an example on. Normally, I do a lot of iron condors over earnings reports, but today being Friday, there's not going to be any earnings today after the close. And another opportunity and moment in time when you can use these iron condors is going to be an options expiration Friday. So you basically have two different moments in time. I think when this trade strategy works pretty well, one of those is going to be earnings. And the next one is going to be expiration Friday. Well, I say expiration Friday, but it actually doesn't have to be Friday. I know there's a lot of traders out there that trade 0 DTE options. You can use it for that as well. But essentially, what you are looking at doing with a trade like this is you're working on creating a range bound trade. Okay. So a lot of the trading that we do at Simpler Trading, I would say most of the trading that we do at Simpler Trading has to do with direction, right? We notice a moment in time where something's changing and we're trying to jump on the move. The reason why this strategy is different is because you are actually, instead of looking for a big move, you're saying, you know what? I think that this ticker is going to stay and trade within a range. Okay. And if you know about the stock market, you'll know that while these big moves are really fun to trade, um, they don't happen all the time, right? There's a lot of the time where stocks are just consolidating and they're trading back and forth and they're actually not really going anywhere. Um, they're just staying within a range. So when you're trading using an iron condor, the idea here is that you are looking at identifying a range bound stock or index, and you're making a bet that that stock or index is going to stay within a specific range by the time that your trade expires. Okay, so the reason why I said that these kinds of trades are generally going to be good for an expiration Friday, or for an earnings report is because you really do want, at least with the way that I set them up. I'm sure some people will say, well, that's crazy. You're doing them so short dated. But the way that I set them up is you generally want a quick resolution in your trade. And you're not really trying to draw this out forever. That's why I'm generally looking at expirations of 5 days or less. That'll be 5 days till expiration. And the reason for that is because stocks move, right? So if you're looking at a stock and you're saying, I think it's going to stay within a range. I mean, sure, it'll stay within a range, but for how long? And so that's why I generally will look at placing this kind of trade with, 5 days or less um, on the calendar because it's going to start moving eventually. Now, for any of you who are students of the squeeze and you're looking at this Tesla chart right now, and you might say, well, Danielle, there is a squeeze right here. Tesla is consolidating. Um, there's a squeeze. So, aren't you worried that the squeeze may fire and the stock will take off? Well, yes, absolutely. That is absolutely a possibility, absolutely a fact, and that's why you have to just think about, what kind of trader are you and what kind of trading strategies can you use. Also, if you're a directional trader and you're trying to trade these directional moves, or you're a neutral trader and you just want the sideways action, it is in your benefit to know how to use both strategies, um, so that you can kind of try to come in and make a trade on a neutral side while things are quiet. And then if you start to recognize the signs that this thing is taking off, that's when you'd want to get out of your neutral trade or get long. So when you're looking at an iron condor and thinking about placing an iron condor and thinking, okay, I have an idea. My idea is that this stock is probably going to stay within a range. And my idea is that I think it will stay within a range of less than 5 days. Why do I think that? Let's look at a couple different key points. Well, for one, we do have a squeeze, so that means that you're consolidating. Number two, I would say the biggest one is going to be the fact that it is options expiration Friday. So generally, stocks are very choppy on an options expiration Friday. They're up, they're down, um, but they're just kind of range bound. Another couple points here would be the technical analysis. So you can see that I have one level on here, this red level. This is going to be a Fibonacci level. You can see that price is getting stuck right where that level is. That level also happens to coincide with a pretty big round number and a key psychological value at $250. So anytime you see a ticker getting a little bit stuck at a critical resistance zone that's also overlapping with a key psychological value, that's also overlapping with the squeeze. And then if you look at some higher time frame charts and you say, okay, is there more resistance? Is there price resistance here? Is this a sticky point? A sticky point is just where the stock tends to trade around. So if you just eyeball it and you just look at the chart and you say, where is this stock trading? Is there a lot of trade around this value? You can just draw a line and you can see that it does just keep coming back to that zone at $250 price point. So I would say just eyeballing it and looking at the number of times the price has hit this level um, at $250 is a sticky point. That is, what I would consider a moment in time where you could look at this thing for a short dated neutral trade, which would be an iron condor. Now, again, I like to emphasize short dated because when you're looking at this and you're looking at the higher time frames with the weekly squeeze, this thing is going to go. Okay. I think it can be up here at 300 pretty easily. That's why I would not personally want to place a neutral trade for a long period of time, especially over the Santa rally in the beginning of January. That just doesn't really seem like a good idea to me. But doing something, 1 day or 2 days out, I think is fine. Um, when you're looking at the daily squeeze, you can see there's a huge daily squeeze here. So that one could take off as well. You have a 195-minute squeeze. So anytime you're looking at doing something neutral, you are saying, I think I can get in and out of my trade before this thing takes off. And your risk is always going to be that it could take off and your condor will not work. So, with any trade setup, it is important to understand where you would lose money. And I'll go ahead and show you how I would set up a trade on this in just a minute. But essentially, with an iron condor, what you would be doing is you would be saying, you know what? I think Tesla is going to stay pretty close to this 250, 252 strike price. I don't think it's going to trade outside of a range. We can talk about the range in a minute. You would want to identify a range using the options chain. Um, but you would basically say, I don't think it's going to trade outside of this range. Wherever you set your strikes, that is going to be where your risk is. So, depending on how you set up the trade and the um, credit that you get, you are going to determine your own risk. There's all kinds of ways that you can do this. You can make the trade very tight with very low risk. You can also make the trade very wide, which would have a lot higher risk because your credit is going to be lower. So there's a lot of different ways you can actually set it up, and that's going to depend on your size account, what works for you, your overall analysis. I personally, when I'm setting up these condors, I like to give myself an optimal risk to reward scenario. I see people come in and they'll, risk three to make one. I never ever do those kinds of trades. The reason for that is because if you have one loser, it blows out, three of your winners. So I don't like doing that. People will commonly say, just do it super wide, make the range really big. Well, I don't personally think that's beneficial because it makes your risk to reward really bad. And I'll show you an example in a minute. Um, so that's why I like to make the range a little bit tighter. Now, the common criticism, people will say, well, doesn't it make it, more challenging for it to stay within the range? Well, it does somewhat. But when the trade is tighter, what that means is that you have a better risk to reward because your credit is generally higher. So that is why I will do that, because if I can risk one to make one, my risk reward is going to be far more optimal. And then that way, when you're wrong, because you are going to be wrong, you're not, losing three winning trades for one loser. So when you look at this kind of trade and you say, okay, what strike would you select? If you thought Tesla was going to stay within a range, what strike would you pick? So part of it is just looking at the actual price action on this chart. I mean, you can see right now it's trading at 252. Um, you are in a pretty tight range between 247 and 253. You can see that there's a key psychological value right here at 250. So when you're looking at that, I would start by looking at strikes within this range. It's generally the most obvious once you get to the options chain. So when you're looking at the options chain, the main thing that I'm always going to look at and look for is high open interest. And I'm also going to look for what kind of premium I'm going to get. So when you're looking at the options chain today, it's pretty late in the day to do a trade like this, I think personally. I'm also just not a day trader, so it's not really something that I would really do. But for the sake of an example, I'm certainly going to go through it. Generally, the best thing to do is going to be to identify the middle strike that you want to use and wait until the ticker is right near that middle strike. So right here, you're at 252.65. That is not perfect for an example, just because if you look at your volume and open interest, especially on an options expiration Friday, you are generally going to want to pick the strikes that have the most volume and open interest. In this case, you're looking at either 250 or 255. So sitting right at 252.63, you're kind of right in the middle of both of those strikes. And when you're setting up an iron condor, it's really best if you can set up the trade when the price is at the center strike that you want to use. So if this was sitting right at 250 right now or at 255, it would be much more optimal because your risk to reward isn't going to be skewed because you would be setting up the trade so that there's an equidistant strike here and an equidistant strike here. So in this case, it's not perfect, but I can go ahead and show you a few examples. So you can also look at, you know, the trade into next week. And this is really important as far as a range is concerned with an iron condor. So for today, for example, the range in Tesla is $2.63. So if you're looking at setting up a neutral trade in Tesla and you think, you know, today it's Friday, the market's not really moving. I just want to sell some premium. Um, and I think that, market's not really going to do too much. We're getting into the holiday season, whatever reason you think, right? And these are good trades that you can use on low volume days, days where the market's not really moving, especially during the summer. People really step away during the summer. Market doesn't really move too much, so it's a good strategy to use during that time, especially. But you do have to look at the range. So if the question is, which is better, today's expiration or next week? It's not that there's really one that's better. It's that there's one that will be better for you. Um, I don't I really don't day trade. I did do an SPX day trade. I don't know, I think yesterday or the day before. It's just not something that I do a lot. Um because I do a lot of TV and I just, I'm getting ready for my shows. I'm going back and forth with the producers. There's just no way that I can manage day trades on top of that. So that's why I primarily swing trade. So it just doesn't really work for me, but there's a lot of people that like day trading. Um, you can do either one. You just have to set up the trade differently. Um, in this case, for this exact example, I personally would not want to bet on Tesla staying in the same range for 7 days. I just think that would probably be near impossible for Tesla to do that. So I personally would not want to use that strategy on Tesla. I would be fine with doing it shorter dated just because, you can get a day or two where it doesn't move, but 7 days, you would just have to set it up differently. So if you were looking at today, do you see how your expected move is $2.63 versus next week? Your expected move is $13.21. So if you were going to do it today, you would need to use a much tighter range because that's all that it's expected to move. With it sitting at 252.80, let's just price it out and I'll show you what it would look like to make it centered. So my menu goes off onto my other monitor here, but I'll go ahead and set it up. You just click on Iron Condor. So you're just going to right click and you're going to do sell. And then you're going to go to Iron Condor. That is the way that the Iron Butterfly is set up in Thinkorswim. So basically what you are doing is you would be selling the center strike on both sides, the call side and the put side. Okay. So basically what you would do is you would say, all right, what my goal is I'm going to make a range bound trade on Tesla. I know that the market maker expected move is $2.55. When you look at the money premium, you can see there's about $1.30 here. There's about 89 cents here. And so if I sell the at the money calls and the puts and Tesla just trades inside of a range, what I'm going to have is a trade that ideally has theta decay until the market closes. And I can then buy it back for a lower price, 15, 20 minutes before the market closes. That would be the purpose and the goal of this kind of trade. Now, when you do that and you say, I'm going to sell the at the money calls and I'm going to sell the at the money puts because I'm going to collect a premium here and I'm going to collect a premium here. And as those options trade, that theta is going to decay. And ideally, I can buy it back and make my money. But if there's some kind of calamity, if Elon comes out and makes some crazy tweets and Tesla drops $10, I don't want to have unlimited risk on my account. So that's why I'm going to buy some protection. I'm going to buy a call, and that call is going to be higher than where I sold my call, because that way, if Tesla flies through 255, that's where my risk is defined. I'll never be able to lose more money than where I defined my risk at 255. And the reason why I would place the upper strike there is because that's where the range is. The range today is $2.55. And then I personally would make it equidistant, where I would again buy some protection on the put side at 250. And so then I would have a $2.50 range to the put side. So let's see, let me actually change these strikes. So the call strike, 250, 250, 255, and then I would do it just the same strikes, 255, 250. So I would set it up like this. I would say, okay, let's do 250, 250, 255. So you're basically selling a call credit spread right at the money. And then you are also selling a put credit spread right at the money. And you're doing both of those to create this range bound trade, where, as long as it stays within that range, then you can get your money. So because it's already so late in the day and today's Friday, this is only going for $1.57, $1.58. It's really not that bad considering it's $2.50 wide. So when you look at the risk to reward, you always want to see what that looks like. And in this case, your max loss is $92 and your max profit is $158 per contract. So it's actually pretty good from the risk to reward standpoint. As I had noted before, I generally like to have around 1-to-1 risk to reward. So, max loss of $92, max profit of $158. It's not bad. It's pretty close. So the idea would be, try to sell this right now, and you can see that your break even prices are 250.91 and 254.09. So as long as the stock doesn't go through either one of those prices, then you should be able to buy it back for a profit. Generally with these, if you can target, 50% of the credit, 70% of the credit, I think that is just fine. So if you're, taking in $1.57 credit, you try to buy it back for like 75 cents, try to buy it back for $1. And then, all you're doing is you're just watching your theta decay, because if you look at what the intrinsic value is and the extrinsic value, of the option, you can see how much of the value is going to decay. So with any option, do you see how with the 250s, I just put the extrinsic value on there? And the extrinsic value is 92 cents on that side. The extrinsic value on this side is 94 cents. So if Tesla doesn't move, that is what's going to decay by expiration, which is today. Does that make sense? So there's just not really a great way to answer the question, which is better today or next week. I mean, it's just different. So for next week, for example, the expected move is $13. So you would not be successful setting it up $2.50 wide. I could almost surely say that. You would need to encapsulate the range for next week. So that would be $13. So let's say if you did sell iron condor, just make it 250 to make it easy. You also want to make sure you're selling it because the entire point of doing this um is going to be to take in a credit. So you're trying to take in a credit. Um, you don't, at least with the way that I'm explaining it and setting it up, don't really want to be buying it. That would be a different idea and different trade. The way that I'm setting these up is I'm saying, you know what? I just want to sell premium. I don't care if it goes up or down. I just want it to stay within a range and I just want to sell premium and I just want to buy that premium back later because I don't want to look for these crazy upside moves. I just want to sell these options and collect an income. So if you're looking at next week, that is when it wouldn't matter as much to set it up with the exact center strike because the range is wider. Today, if you were doing it today and you selected your center strike as 250 and you're already at 252, you're pretty far away from that center strike. So I think it would be hard to be successful. But for next week, I mean, you can see here that there's pretty high open interest at 250. There is higher open interest at 255, but I would say most of the activity is around 250. So generally, if I'm going to be selling options, I want to sell them where there is that high open interest because the options market, it's just there's a lot of trade surrounding that price. It's a really sticky price point. It's just a fact that options see a lot of activity at these key psychological values. And we just tend to see a lot of trade at that level. So that's generally why I'm always going to pick those levels over anything else. So if I was going to set it up for next week, which again, I noted just isn't really my favorite trade idea because the likelihood of Tesla not moving for 7 days is very low. But I have seen people where they set up these kinds of trades and they'll do it. Let's say you sell it today on Friday and then you try to buy it back by Tuesday. You could get a little bit of decay by then. I mean, it's not going to be like 100% winner or anything. I mean, you could maybe get 20% out of it. That would be a much more conservative, lower risk way to trade it. But I don't think that waiting all the way until next Friday would be a good way to approach this because I just don't think it's very likely that it would stagnate for that long. So there's a couple different ways, you can put that on and think about it. I used to do a strategy when I first started trading where I would do these 60 days out and do it 60 days out and buy them back 30 days out. And I do them really wide. So that kind of thing you certainly can do. I guess I just kind of got bored of it because it was, it takes a while for them to for them to come through. But you can do stuff like that with this kind of option strategy. So if you're looking at, next week, you would want to encapsulate that expected move because the entire point of the condor is you're saying, I know the stock is going to move, but I don't think it's going to move outside of this range. So if the range that's being expected is $13 and you set it up for $15 wide, that'll give you a little bit of leeway. And so, if you did the center strike at 250, where I noted where that high open interest is, and then you say, okay, I'm going to sell the 250s and I don't want to be naked, which is when you would just sell the 250s and not have any protection. But let's just sell the 250s and let's buy another leg for protection. That way, if Tesla goes absolutely crazy and trades up to $300, what am I going to lose? Where can I take a stop? What am I going to lose? What's the worst thing that could happen? So with the condor, what you're doing is you're defining your risk. You're saying, if it goes up above 265 or below 235, that is where my risk is defined. In this trade, this is a $15 wide trade. It's $15 wide because it's 15 on that side and it's 15 on that side. And you're getting a credit of $9.13. So when you get that credit of $9.13 and you have a risk that is $15 wide, the most that you would ever have to buy this back for if things went terribly wrong, you would have to pay $15 to get out of one side because it can't go through both sides, right? So it can't be all the way up at 275 and also below 225. So the way that they go wrong is if it goes outside of one of these ranges. Okay. So um if it ends up at 275, what you would have to do is you would have to buy back the condor, or really just the call side, for $15. But since you got a $9.13 credit for getting in, you'd be losing, a little bit less than $6 on the trade. So if we look at the risk to reward, you can see that your max loss is going to be $590 per contract, which is, about $6, $600 in the options market. So your max loss is about 600, your max profit's about 900. Not quite 1-to-1, but it's still pretty good on the risk to reward ratio. As far as like where you would take a stop, so a lot of these I'll do over earnings, and when you place them over earnings, you can't take a stop because it's over earnings and stocks can gap over earnings. So I generally set them up with the risk that I'm comfortable with. So I'll risk anywhere between $200 or $1,000 per trade, depending on what I'm doing. With these condors, I generally will risk around $500, and that's my full risk because they're overnight. If you're doing it as a swing trade, there's no reason to risk the whole amount. You know, what I mean by that is if you can see that it's not going your way, you know, if you place this trade and Tesla's up 5% tomorrow and you're down 50%, I mean, you can take it off, right? Um, but you don't want to in your mind say, okay, well, I'm going to risk $1,000, but my stop is going to be $500. Because with these kinds of trades, when they go wrong, it's generally because of a gap. And so if it gaps and you're down the full $1,000, you lost twice what you thought you were going to lose because of your stop. Does that make sense? So I think that it's best for these kinds of trades to and really for any kinds of trades, just to go into it risking what you're willing to actually lose, because you could lose that. And then that way, they're a lot easier to manage because, you put it on and you just let it ride. So with some of these, yeah, it makes sense, right? And so, there are with some of the, let's see if I can find one for earnings for next week. With some of the earnings trades, what will happen is I'll place these trades, and let's say, for example, it's at a break even first thing in the morning. You will get a break even if, for example, you're looking at a trade, you're looking for a ticker to stay within a $10 range, let's say, and then you sell the condor directly before earnings. The next morning, you wake up, you look at the market, um, the ticker moved exactly $10. If the ticker moved at the exact amount of the credit that you sold, you're going to be at break even. Okay. So, in my way of thinking, a break even is always better than a loss. And if I'm at break even, I would much rather close it, especially if the ticker is moving and it's showing signs that it's going to go outside of the range. I would rather take a break even than a loss. So I would consider that to be a stop loss, break even stop loss. Um, if there's just no, for me, it's not one of those things where I look at it and I say, oh, it's at break even. Maybe I should just hold it a little longer and I could make money on it. That's only if the setup is actually doing what it's supposed to do. Like if it moved $10 and it's starting to fall back into my range, then fine, I'll hold it. If it moved $10 and it's going outside of the range, like get out. Does that make sense? So it looks like we have FedEx next week, General Mills. The question was, do you like to use IV volatility? So I would love to do like another full video. The video that I'm making today is primarily about like options expiration, iron condors. I could definitely make another full video just about the earnings ones because that is going to be a little bit different. Um, when you're looking at, for example, um, condors just for like a Friday expiration. Um, the main thing that I'm looking for isn't necessarily IV. The main thing that I'm looking for is going to be one of these Magnificent Seven stocks. Um, Tesla, Apple, Netflix, Amazon, Google. The reason why I'm looking for these is because they always trade at their sticky points. So Amazon, if you look at the sticky point is 150. You have 49,000 contracts here, and it's trading at 149.17. If you look at Microsoft and you see what the sticky point is on this one, you've got 17,000 contracts here at the 370 strike. If you look at Netflix, you can see that you have 2,900 contracts at the 470 strike, and you see how it's just below it. So if I'm going to do an options expiration condor, it's going to be on one of these major names because they have the most options activity. You'd also do it on the SPX. I think today 4,700 is I think it would be a pretty obvious target with the key psychological value there, right near that 4,700 strike. So, you can use the strategy as well on the SPX. It's not perfect with it trading at 4707. Generally, if you're going to sell a condor, it's going to be more beneficial to you to sell it when it's trading closer to that strike. And the reason for that is because do you see how this strike says it's going for $11 and this one's going for 265? So it's kind of slanted. You really want to try to sell it when you're getting close to the same premiums on the same sides. Otherwise, it's just not a neutral trade. It's not really neutral because it's so slanted on that side. So you can do it on the SPX. You can do it on any of these other Magnificent Seven stocks because those are the ones that have a lot of options activity. Those are the ones that are really sticky. And those are the ones that are just generally going to go to those sticky points. So it's not necessarily IV driven. Now, when you're looking at earnings, that is certainly IV driven. So when you're looking at selling something, an earnings condor, let's say, for example, next week, Carnival Cruise probably has some pretty good implied volatility. You could look at that one. Micron certainly would. BlackBerry probably would. Maybe Winnebago, General Mills, FedEx. So you generally need a stock with quite a bit of IV crush. So if you're looking at General Mills and then you're comparing that to like Micron, you can see. So I have this tool on my earnings hot zone where it shows me how much the implied volatility goes down after earnings. So General Mills actually has quite a good IV crush, actually. Kind of surprised by that. Let's look at FedEx. So FedEx also has pretty big IV crush. Let's see, Micron, pretty good IV crush here. So you can see the way that the volatility goes up and then it hits earnings and it goes down. So when you're selling strategies like that over earnings, it's going to be a little bit different because you're going to have to look at the expected move over the earnings report. You're going to want to look at the implied volatility and see, you're just going to want to see how much this thing goes down. So for example, FedEx, the implied volatility next week is 46%. And if you look about a month later, it's at so the IV crush is not that great there. Only going down like 15%. If you look at Carnival Cruise Lines, this one is going to be a lot better. So this one would have better IV crush because you can see 77% going down to like 54%. But even that is still not that big of a drop off. See if I can find a better one. Kind of at the tail end of the season here. So 56 to 40%. It's not great either. Let's look at BlackBerry. You generally want to see it going down by at least half, if not a third. So for example, this one is 100% going down to 65%. It's like, not quite cut in half. Or 2/3, I guess, but so yeah, that would be my explanation of iron condors. I think that I answered most of the questions. If you have any other questions, definitely let me know. Is there a rule of thumb to determine whether the $9.13 is fairly valued for 7 days till expiration? Do you just look at the risk to reward, or is there a way to calculate fair value? I really just look at the risk to reward. I know that's a pretty common question, is it a fair value or not? But what I'm doing is I'm looking at, what is the expected range? So if the expected range is $12 and I can go and calculate the credit that I'm getting. So if I just looked at an SPX one for today, and if I said, okay, there's a $12 range, let's set it up just a little bit wider than $12. So let's make it $15. So $15 wide. And I'm getting an $8.45 credit. That's how I determine if it's quote unquote fair or a good credit, because you want to see the credit being as close as you can to what the actual move is. So the idea with that is, you know, you don't want to sell a credit of $5 if the expected range is going to be $12, because the likelihood of it staying within your $5 is very, very small. But the likelihood of it staying within $8.50 when the expected range is about 12, I mean, that's pretty good. You've got another $3 or $4 in there that's not covered by your credit. But I would say that's pretty close. So that's not bad. If the credit is going to be, half of what the expected range is, that's when I would say, okay, that's not a fair value. It's not a good credit. Stay out of it. And I mean, you can also just tell by doing the risk to reward. Um, it's not bad, 660 for 840. You'll notice that if you make it tighter, your risk to reward will come down, but your credit's also going to come down. So if the expected move is, $12 and it's giving you $7 credit, it's not bad, but it's also brings down your break even prices quite a bit. The thing that I would definitely avoid is just making it super huge, just because there's just not really any, I don't really see any upside of doing that, because I mean, if you make it something like this, for example, so if we did it like this, $10 credit. So at this point, your max loss is going to be a lot better than your profit. So if you make the range wider, your credit's only going to go up incrementally, and then your max loss is just going to get bigger and bigger. So you might think, oh, my break even is further away. Yay. Okay, but you just made your max loss larger. So that's why I try to avoid that. Because if you're going to be wrong, you're going to be wrong. If it's going to gap through your strikes, it's not going to make that much of a difference if it's, $5 more one direction. And so you might as well lose less money if you're going to be wrong. Does that make sense? When you pick one for longer periods, like 3 weeks, how do you determine the middle strike? Do you add any number to the middle strike if the stock is bullish? Like in Tesla, if you had 250, would you stay at 250? So I don't place them for that length of time anymore. Generally, if I was going to do that, I would probably only do it on the SPX, because with the SPX, you can use a wider, like $50 range, especially if something's consolidating for a week or two. It's still going to be the same idea, where you want to place the trade at the center strike when it's trading at the center strike. So if you, for example, wanted to place a trade in the SPX for 4,700 for 3 weeks out, you said, I think the SPX is going to stay and chop around 4,700 for the next 3 weeks. It would be the same thing. You would want to come up with that idea from technical analysis first. In this case, I don't think that would make sense, just because you see how the SPX has already had just this huge move and it's extended. I mean, I think it's more likely to pull back and hang out here. If you wanted to do it, for example, because there was a weekly squeeze, that's something that you could do. That's how you would want to choose the strikes. You would want to choose the strikes based off of technical analysis, based off of, we're going back and forth around a key psychological value like 4,000. So if I was going to do something, that far dated, I would generally use the SPX. At least that's, what I used to do when I was doing those kind of trades. It's really hard to get an individual stock to stay at around the same spot for that long unless there is a weekly and a monthly squeeze. Like Tesla, it does have these weekly and monthly squeezes and it's been consolidating. But these kind of stocks can move a lot. So that's why I don't usually do it for 3 weeks. And if I was, bullish on a stock, then that's when I would change instead of like the iron condor is a neutral trade. So if I was instead bullish and I wanted to make a trade on Tesla 3 weeks later, what I would do is I would use a butterfly. The condor is meant to be a neutral, range bound trade, theta decaying trade. But if I was bullish and I thought, Tesla was going to be up here at 280 or 300, that's when I would use a regular butterfly. So I would come in here and I'd go out, 3 weeks into January and I'd say, okay, Tesla is supposed to be moving about $30 into that time frame. What kind of technical setup do I have? I have a weekly squeeze. I have a daily squeeze. I have my trend strength candles going from red to yellow to green. And I have a target up here at 280. So can I place a bullish butterfly? Can I identify, where is my high open interest strike? It's right here at 280, 18,000 contracts. And at that point, I would say, okay, I'm going to do 250, 280, 310. And I'm going to pay $6.85 for a $30 wide butterfly. And I'm going to risk $685 and I'm going to target a max of 2,300. So generally the center strike is always going to be a high open interest value near a target zone, near a support and resistance zone. But if I'm going out 3 weeks and I have a bullish price target, then I would not use the neutral iron condor. I would use the regular butterfly. Yep. All right. Well, it appears to be the end of my time with all of you. This has been a lot of fun. If you have any requests for me for future sessions in the Essentials room, please let me know. You can type it in the chat down below with your request. This session was actually requested by a member, so I hope you enjoyed it. If you have any other further requests, let me know, and I'll be back in here maybe on another Friday. I think Friday is a pretty good day to do these sessions, I think, with your next request. Okay, please do butterflies. I would love to do a butterfly one because I trade a lot of butterflies. So that's definitely something I could do for you. All right, great. Well, I hope everyone has a great rest of your Friday. I hope you have a fantastic weekend, and I will see you next time. Thank you very much.